Hello, and welcome back to the StoreHero podcast. This week I'm joined by Katherine Chan, co-founder and CEO of Juice. Katherine, welcome to the show.
Thank you. It's a pleasure to be here.
Great to have you on board. Where are you dialing in from today?
I am dialing in from sunny Soho. So in our office today, pretty empty given it's a Friday, but yeah, I have the roof terrace all to myself.
A nice little view over London, I'm sure.
It's not too bad, but anyway.
Absolutely. Listen, Catherine, we always kind of typically start these shows by getting the guests to give a little bit of an intro to themselves, who they are, where they're from, and maybe some of their previous background as well.
Yeah, sure. Prior to my life at Juice, I spent probably a little bit too long in the banking world, but that is where I cut my teeth. And I learned the tools of the trade. I worked for, I guess, all the kind of household organizations, HSBC, Lloyd's, always on the more credit debt side of things, and very much also kind of focused on kind of like the finance risk aspects as well. So I decided after 15 years that I could end up like with a big team and big title, but I wasn't quite sure that was really what was going to kind of get me jumping out of bed every morning. And that's when I met the guys at Velocity. So they're an equity fundraising platform, and they had a portfolio of companies at the time that they raised, EIS, SCIS funds for. But they were just finding that with these companies, when they were trying to just push growth, that it was just highly dilutive. And that's when I met them, and the idea of debt as another way to do things. That's how it kind of all came into being. So, yeah, that's a little bit of background on me. I guess, never really thought I would end up at a startup, to be completely honest. It's one of those things where, but my attitude to life is you kind of just roll with things, you take opportunities as they come, try not to be too boxed in, just to leave yourself open for opportunities or whatever that challenges that might come your way.
Yeah, it's a big shift, I'm sure, out of the being in those institutional names for such a long time to up sticks and really jump back into a startup.
Yeah.
I'm sure it was a great move. Be interesting just to kind of get you to describe what you guys at Juice actually do. So you kind of mentioned debt, you mentioned you've come from a banking world. I'm sure a lot of our listeners can probably deduce roughly kind of what you guys do, but it'd be great to kind of hear it from yourself.
Yeah, sure. So, when you're a kind of e-commerce digital brand or any SME for that matter, trying to grow your business, trying to access finance, the right kind of finance at the right times, it can be a bit of a minefield, and sometimes the wrong decisions, it can be quite a costly kind of mistake later on down the track. And, that could be in terms of you've given away too much control of your company, you've given up too much kind of shareholding or ownership of your company as well. Or you could just be tied into a very kind of punitive type of financing arrangement as well that actually kind of is net negative in terms of your growth. So at Juice, we provide an alternative form of capital, which is so it's not just equity. That when you ask founders typically how do you grow your company, what type of financing do you have access to? Scarily, sometimes the answer is credit cards, which is, yes, that is a form, but probably not one that's going to, that will be very costly and not going to get you, to the stage where you want to be. There's bank loans as well. Banks are it is challenging, I think, for probably like seed series A, going up to series A type of company, they're the type of companies that we normally kind of face or try and serve. It's very difficult. I think the banks just they have shown it that then that's not really the space that they want to focus on. They've really kind of pulled back from that area, so that's tricky. And then there are other forms of debt financing, like venture debt is another form, where, however, again, that's kind of like usually quite long term. You'll have like a sponsor, like a VC, in there as well. It's not probably like the push of capital that you really need. So we provide long term lines of credit. We're one of the first in the market to provide this product. I think people might be more familiar with MCAs, merchant cash advances, also known as revenue-based loans, where typically a founder might repay that financing through a share of their revenues. That's been very popular, and it works in some instances, and suits certain types of companies. Whereas we provide kind of it's a 2-year facility, which we think gives the company the flexibility and also the peace of mind that they will have access to the financing as and when they need it. We don't want to pressure companies to take financing just because it's there. It's only when it suits the company to take on the financing. We also have quite a different approach to the way in which we lend. So I have a fantastic team who genuinely care about the businesses that we support. So we try and be much more than a financing partner to these companies, and to try and actually be kind of like a value add partner through the entire 2-year journey.
Interesting. So like just to kind of double click on that, because obviously there are other financing facilities out there for e-commerce brands. And you kind of touched on the difference between an MCA, revenue based financing, where they will repay, remittance will be done through a percentage of daily sales or weekly sales or whatever it's going to be. So you guys tend to operate kind of on a longer term horizon, maybe 2 years, and you kind of have the flexibility to draw down capital if and when you need it without any obviously pressure to do that. What is the difference in terms of remittance that you guys tend to operate with as opposed to a revenue-based financer? What's the difference there?
Yeah, so we're trying to build in. So we already see our product as very flexible in the sense that you only use it when you need it. You only pay for what you use. But as we speak right now, we're actually rolling out another feature, which is that the business or the founder can choose like the terms in which and how they repay. So it's we have bullet repayments, which is, I think the guys, they've termed it as a one and done, or no, sorry, no, in one go, not one and done, sorry, in one go. And then I think the other one was pay as you grow, which is so one is a bullet, which is basically it. So this suits companies where because the last thing you want to do is take out financing and you haven't started earning the revenues that is meant to be used to repay. And I think so that's, I guess, how it is different from an MCA or a revenue-based loan, where you draw down and then you have to start repaying, like sharing your revenues. And typically it's 20 to 30% of your revenues as soon as you draw down the cash. And that is tricky for someone who, say, wants to buy stock from across the seas, and that might take, I don't know, 3-4 months to get here.
Easily,
and then, and then their own kind of terms in which the kind of retailer terms, for instance, that could add on another couple of months to the working capital cycle. And to put a company into a situation where they have to start repaying when there is no manifestation of revenues is a little bit tricky. So for these companies, we would typically suggest that they take our bullet profile. or the pay it, no, not the one and done one, the other one. The in one go product. So this is all very new and obviously not my is not my area of expertise here or branding. And yeah, so that we try and marry up the repayment cycle with the cash generation or cash conversion cycle, so we call it. And we've, however, just talking to our clients, and trying to understand what they need. A lot of them are like, well, actually, I'm more like, I want to use you for marketing. And so that's something else that we support. Typically, it's inventory marketing and refinancing as well, but I can talk about that a little bit later. So for marketing, it may well be that the cash conversion cycle is a lot quicker. You push a lot on, say, paid, and you're starting to see the uplift in your revenues straight away. And so they don't want to. These founders are like, why do I need to wait around and pay you back in 3 months? I've got the cash now. And so that also reduces their cost of capital or how much they have to pay for the financing, because it's all about being efficient and smart. And I can talk about, being smart with your financing later on as well. But it's about being smart about how you grow your business, so that you maximize the ROI for, your financing activities. Yeah, so that's the kind of flexibility that we like to introduce, that we like to offer. And really, when we talk about personalization and customization as well, we don't want to be this off the shelf product, but really be able to kind of really partner with the companies, give them what they need.
Yeah, no, that makes sense. I mean, a lot of our customers at StoreHero have obviously worked with you guys as well, and have only ever said good things about speaking with the team, and very much a consultative approach to understand exactly what the merchant is looking for, instead of really just forcing anything out there for the sake of just getting it over the line. So that's definitely I suppose, a bit of feedback we've had from our existing clients that obviously are working with you guys, which is obviously fantastic.
Great to hear.
You guys are obviously around a while. I mean, there's plenty of financiers out there at the moment, but you kind of said you guys are first to the market, or one of the first to the market. I mean, I just had a quick look before we came on there. You're nearly at Velocity or Juice for almost 5 years now. So I think it was October 19, which is quite a while.
Yes, it has been. Oh God, it has been a long time. We've been around a while. I think, our story has been one of two halves, I would say. When I met the Velocity guys back in 2019, the idea was really to help the Velocity companies, actually. The guys, they work hard, they raise a 500K check, and 150 of it goes straight into marketing. No good. Everyone dilutes, and very expensive, because equity is a far more expensive form of capital compared to debt. That's just something to add, I think. So I don't know, sometimes people don't realize, just because you're not paying interest, but as a founder, if you're giving away equity, like, I don't know, you're diluting 10-20% with every round.
Huge.
How much of that value are you actually giving away when you come to exit in, however many years' time? And so I think it kind of went from that type of frame, which was kind of like the lending arm of Velocity Capital, where we were very much focused on just helping that group of companies. It's kind of, morphed in a great way, I guess, or spun off to become a business model in its own right. And I think that is very much led by market demand. Customers coming to us looking for solutions, which has meant that we've kind of really, I guess, broken out of that that smaller ecosystem that we were initially conceived to try and support, to now really broaden our offering to the entire digital SME market in the UK. So it has been a while. I would say that when I first came on, there was this big bubble as well of revenue-based lenders, and I was a little bit. I thought, oh my gosh, should I just do that? Because everybody's doing it.
Yeah,
But I not do that and just stick with what I genuinely felt would be a product that was just far more flexible and would offer the founders, just without adding pressure, to repay when, say, revenue generation hadn't yet happened. I
sure.
wanted to offer something that was longer term, and with a different angle where we could actually take a company from, like, there's nothing more, I think, rewarding than, say, when you have worked with a brand who is very early on
Yeah,
and they're on like 30K revenue a month. And then they use Juice. You can see their growth, and sometimes they actually outgrow us, which is sad, but it's great in a way as well.
yeah,
I think we've done our job then.
yeah, yeah, yeah.
Yeah. And that's probably the most rewarding piece. But yeah, it's been a long while, and I think that in the first 3 years, I would say we were very much just in that velocity support ecosystem, just kind of finding our feet, understanding what people liked, clients liked, what they didn't like. So a lot of product refinement. We also built out our own platform at the time, which was just the thing that I kind of thought, why not? I didn't see anything in the market at the time that was what I felt was right to help support Juice in terms of infrastructure. So decided to build one. And so that actually took a lot of time and resources and kept me busy for the first 3 years. But now we're open to the market. We've met partners like StoreHero who have been fantastic, how together we can kind of help and support e-commerce brands from with different, from a different our different respective angles. So yeah, I feel like we're kind of just at the start of our journey, even
Nice.
though we've been around for 4 years. But I really do feel like this is just the start.
You're getting going.
Yeah,
It's an interesting one. I mean, just that to your point there. It sounds like a really nuanced point for maybe some people listening in, but I think it's such an important point. And if you kind of touched on lead times potentially, particularly with ordering new inventory, potentially being 3-4 months before that inventory starts to generate cash.
yeah,
And if you draw down credit and, if you say, for instance, it's what now, it's the 1st of August, whatever it is. And if you can't start shifting that inventory until, mid 4 months time, mid-December, if you were to draw down capital and you had to start doing daily remittances, you would probably need to be in a position to draw down excess capital just to pay off the remittances between the time of when you draw down the capital and when it actually starts converting back to cash as well. So I think the flexible approach, while it might sound like a very nuanced point for some people listening here, it's such an important detail that obviously would save you a ton of money in the long run as well, just with the flexible approach that you guys tend to offer. I suppose one thing, Katherine, I'd like to double click on as well. Obviously, you've mentioned you've been around 4+ years. E-commerce has changed profoundly in 4 years. Be curious, just kind of get your thoughts on, what the market would have been like 4 years ago and even where it's at today, and maybe some of the changes that you've seen with some of the business that you've been working with.
yeah. I mean, I highly commend e-commerce founders. It is a tough gig. Anyway.
Same here.
I got to say that when we started trading, it was at the start of COVID, pretty much, right? So and then like 2 months later, we all were in lockdown. Yeah, I think that was the like, and it's sad. In the
Just to stop there for a second, what was that like, moving company to a company that, like, COVID was obviously a massive shift for everybody, but joining a new company after leaving the the household names for such a long time, and then going into a new company, not being sure what was going to happen, and then everybody in lockdown. I mean, the first couple of weeks of COVID before ecom really took off were quite scary, really.
Yeah, yeah, it was. It was. I mean, it was a. I don't think I knew what I, if I'm honest, I don't think I knew what I was getting into. It was it's really different. Like in your, from that old world. Yes, very impressive transactions, and like tombstones, great, but it's not personal at all. It's highly everything had an extra, I don't know, three, four, five zeros at the end of it. But it was completely anonymous. Whereas here, the impact of what we do or don't do, the decisions that I make, my team makes, has a profound impact on someone else's business, their livelihood, um, it's so I think even though you're dealing with much bigger numbers like in that world, but here it's like, but the impact is so much bigger. And that's something to really kind of, I think sometimes I need to step back, take stock, and think, this isn't just a new policy I'm rolling out. Like this is, uh, these are people's businesses, lives that you're impacting, and so it's a great sense of responsibility, I think, that has come with it, and I don't know, like. It was a massive change. Like I love to build more than I think I realize. I don't think yeah, it wasn't until I started doing it, I was like, this is what I love. This is what really gets me kind of springing out of bed every morning. But it was a massive learning curve. So like, it's still on a massive learning curve. But I take every day with, I just yeah, it's yeah, another kind of I was going to say take every day with gratitude, which sounds very like cheesy, but I do. It's and also, but I am, just because of just the learning opportunity here. But yeah, the shift was massive. I had no idea about this ecosystem, this environment. If you talk about, because juice, where, had to build business as well, right?
Sure.
So even though we've got institutional funders, but I'm still building a business, and to learn that as well is like, and coming in fresh, that was a challenge. I sometimes feel like it's a bit of a club, like everyone kind of knows everyone already.
Sure.
It's like, oh, okay, and how do I join the club? Yeah, it's a massive adjustment, but one that I have loved, but it's, yeah, been a journey.
And with the brand specifically, obviously, when you guys would have started out, even just looking back at myself, like 2020, even the cost of advertising was a fraction of what it was today for the majority of brands. Has that piece, for me, the cost of advertising and Facebook ads particularly, that has been fundamentally the biggest change in the last 4 years that is impacting brands. How has that affected what you guys do on a daily basis? Has it been a driver of brands needing more capital to fuel their marketing efforts? Curious to understand your kind of thoughts on maybe the cost of advertising and how that has affected the industry as a whole.
Yeah, yeah, sure. I mean, like, absolutely. And I think that we've found that brands have to be more creative also
Yeah,
in how they outreach to their audience, because there have been so many headwinds that have gone against the e-commerce founders, right? It's not just the cost of advertising. It's like
no,
just the cost of, just cost of goods, everything, like the lead time to get goods over into the UK to distribute. So for us, that's why we've had to broaden out our product offering as well. So it's not just supporting kind of like digital ads, but we try and support, if so long as the data's there, because it's all about, for us, we try to harness data and tech to be an efficient channel of capital of kind of growth financing to companies that need it. It's yeah, yeah. So but we have moved from just pure marketing to supporting inventory as well. We feel that companies, their need for inventory almost sometimes outweighs the need for marketing. It's
Sure.
kind of, yeah. Yeah. It's so in response to, yes, certainly it's the changing landscape for ecom. We've tried to adapt and just broaden out and increase flexibility in our products.
Nice. Okay. Really interesting. So, I mean, there's a question we probably get in a lot of our calls with merchants where, sometimes they have enough cash but they have larger growth goals, and sometimes, cash might be tight. They might need to kind of, might need to just keep the lights on to a certain extent. Is there better times than others, or what if you were speaking with a brand owner? Is there really good times to take on capital? And conversely to that, is there like times where just it's not a good idea at all, really? Like, is there times where if you have enough cash in the bank and you're not going for really lofty goals, or alternatively, maybe you have a good cash supply, but maybe you're not being ambitious enough, and you might need an extra kick of capital to really make it happen? Just curious from your own perspective, from the years in the industry, when is the best and the worst time for brands to really take on external capital?
Yeah, that is a good question. I can't stress enough. By the time you think you need it, it's probably too late. Not. It's just because as a capital provider, it does come down to risk at the end of the day, and
Sure.
the likelihood of getting repaid. And if a business is down to just a couple of months,
Very hard.
as much as you want to support them, you think, why didn't we talk 6 months ago?
Yeah.
Yeah, but probably in the founder's mind, they're not focused on that, 6 months ago, because it was not front of mind. But really, I would urge founders to really just think ahead. Just everything add a 2 month buffer on top of when you actually think you need the cash. So I think the time to not raise is probably when you're just trying to make you be. That's probably a little bit too. That's going to be an uphill battle, I think. And also, I think sometimes founders might think I'm sitting pretty. I've just raised, for instance, but so I don't need an alternative form of financing. And I would probably just comment on that to say runway preservation is probably a key point. So even if you've just raised, you've got 12 months, you could really, preserve what you've just raised, use that to, let that be your burn capital for just like infrastructure, teams, systems for the next 12 months. Don't use that. Well, you can, but maybe you can find something else, another form of capital to just top up and push the growth. Now that you've raised, fantastic. Now go out and grab that market share, but preserve your hard-earned equity funds as well, like what you've just raised. So I think that you can always improve your working capital cycle as well. Like if you harness financing, in a positive manner, and when I say positive, it's when you can use to push growth. Make your working capital cycle more efficient.
Hmm.
That's always a good time to just be a little bit savvy about the financial decisions that you make. The worst time is when you realize that you need it.
And what would you say now? I was on a call with a brand probably quite recently where, they've had a really, really good start to the year, and last year was quite strong as well. And I kind of broached the topic of, really, I was looking at the numbers in StoreHero, and I was like, I think you have a massive opportunity in front of you here. And they're like, yeah, that's fine. We have a decent cash position, and we're not really looking to take on any external capital. We don't need to do so.
Yeah.
But by not taking on any external capital, it was probably going to put a chokehold on potentially what I could see as a really, really good opportunity in front of them. What would you say to a brand that, is growing at a really steady clip, has a decent cash position, but maybe is, I wouldn't say frightened, but, skeptical of taking on potentially outside investment?
Yeah. I would say, I would say that's kind of like the role of Juice. I would love, for
Mm,
Juice to talk to this kind of company, because my hope is that it's not just the financing, it's not just the pure capital, but it's the whole proposition about, what do we want to do? Like Juice, we talk about, we want to give founders the confidence to grow. And
mm,
how do you do that? You want to know that when you put one foot ahead, you take that risk, you take on a debt line, you know what you're going to get off the back of that. So you know how much you're going to be able to grow your business. The kind of like the kind of revenues that you will be able to generate off the back of you
sure.
taking that risk, on taking a debt, a credit line. And we do that through our insights dashboard, for instance. So we offer companies, it's a tool that helps them understand, the impact on profitability, from marketing spend, right? Finger in the air, kind of investing blindly, into an activity that you don't know what the impact to your bottom line will be. Because in
Sure.
my mind, it's all about making informed decisions. And that's
Yeah.
why we use a phrase here at Juice. It's called smart growth capital. So it's
Hmm.
not just growth capital for, that you're just getting more cash into the business. It's capital that is smart. It's well informed. It's considered. You know what impact it will have to your business by taking this. It's a very conscious decision that you're taking and so that's what I would say to that founder. Like, if you have the data at hand, and also, we try to offer support in the form of, we've just launched a growth hub. Which was, I think the first one went fantastically well from the feedback that I've heard. Yay! And it was just a group of like-minded founders. Some were
Sure.
really early on in their journey. Others were really experienced, seasoned veterans, multiple exits, and just getting them in the room together. No kind of like agenda, in that. It was just offering that network, and we're trying to do more stuff like this. We're going to roll out a breakfast for founders, for instance.
Nice.
So, yeah, and so really build that support infrastructure. I think off the back of that event, people wanted to open up Slack channels, etc., to really, be able to just draw on each other's, support, experience, and that's how I want to help founders. So it's not
Mm.
just throwing you a 50K check that may or may not be topped up, in 6 months' time. It's taking you through, supporting you through that whole journey.
It's definitely a different model, the smart growth capital. Obviously we have the flexibility and the payment terms, but I'm actually just on your website here. So there's actually a quote from an Irish founder. So I'm going to read it out. It says that Juice plays a significant role in our marketing to scale. The added value to us is the level of in-house expertise and advice we get on a weekly basis. This is the game changer for any lean startup, and I totally recommend them. So to your point, I suppose you're not just giving that chunk of capital, it's advice, on a whatever regular cadence that you kind of provided, along with that platform that you guys have built to really help you, fuse what's going on in the e-commerce side of things, the marketing and the finance. So it's almost like a trifecta of products that you're getting from Juice as opposed to just capital up front.
Yes, yes. Yeah. I like how you describe it as a trifecta. I do believe. I might use that. I
You
do.
get that one for free.
I do believe that, you need like a system, like pillars of support, when a company is kind of, at that growth stage. And I hope that Juice is so much more than just a lender. And I want us to continue to build and evolve with that vision in mind.
Nice, nice, nice. What countries or even verticals, I suppose, do you guys operate in? Is it largely UK based?
It is. It is. I mean, I don't know. It's my maybe cautious nature. Risk, finance. I just want to make sure that we nail our proposition. We know exactly how we can offer our product the most efficient way that we can do it, make it a great customer experience, just now before I even think about, moving elsewhere. I think that there is already a massive kind of gap in the UK market that juice could
Yeah.
service. So I'd love to be able to just perfect that before moving on. We do from time to time have companies approach us from other jurisdictions, and we have supported companies from the US, companies within EMEA as well. But that's it's not our core focus.
No,
Yeah.
that makes sense.
Mm.
Listen, Catherine, that was brilliant. If people are looking to get in contact with you, where can they find you?
Well, you can pop into our offices at Soho. If you're a founder and you
Up on
want,
the rooftop.
yeah, exactly. We'll invite you up for a drink on our rooftop. And if you're a founder, we're just off Carnaby Street in Soho. And no, genuinely, drop me a line. I'm at Katherine Katherne at getmejuice.com. Have a fantastic team as well who just love founders, and then they would happily want to understand your story and see what, if anything, we can do to support. Yeah, and you can check out our website. It's just www.
Brilliant. We'll leave a link to the website and your own email in the show notes as well. But listen, Catherine, I want to say thank you very, very much for coming on. That was brilliant.
Thank you so much for having me. I really enjoyed it.
Thanks very much. See
Yeah.
ya.